hope you had a good networking coffee break. So next session is about creative accounting. So I have Robert behind me. Just to let you know, last year we had Robert in the afternoon of day 2 conference. I can tell you that was the most entertaining session. So because he brings a unique perspective, talk about creative accounting. I don't want to give a lot of secrets away, but it was just so mind-boggling in terms of what I learned, what I heard. So this year we decided to bring Robert to day 1 in the morning session, so you can hear about all the amazing perspective he brings to the topic of creative accounting. So Robert, I hand it to you.
Thank you very much. Thank you. Well, good morning, everybody. Thank you for taking the time out of your busy work schedule. We're probably the other side of the fence to most of you guys who I believe are involved in sponsoring and advising companies that are looking to list. We are not short sellers. We're often accused of being short sellers, but we're not. We are an independent research operation advising institutional clients. Our speciality is not understanding what I would describe as the business operations. In other words, I have no idea where the price of DRAM is going, and I have no idea how a jet engine works. However, we do specialize in trying to understand how people are presenting themselves, and our focus, as we say on our website, is exposing creative accounting. Think of my presentation a bit like an SEC filing. There's an awful lot of slides, a lot of tiny type, but we're trying to focus in on the key issues and baffle you with lots and lots of text. So creative accounting, which we define as the art of producing accounts that disguise the business reality. And a lot of people talk about fraud, and they assume that that's creative accounting, and to us that's a subset of creative accounting. It was very interesting. I went to a conference in Berkeley in California, or Berkeley, never quite sure which way to get around, and this woman said there's no such thing as accounting fraud. She was a lawyer, funnily enough used by corporates, and her view was that as long as you could come up with the right precedent, the right level of optimism, and a fairly dubious standard shopping, it was almost impossible to prove that anybody was either intentionally negligent or was doing anything that wasn't in the best interest of the firm. Which is why we always say that fraud gets the headlines, but it's creative accounting that costs money. So if you think about the last few years, people have lost far more money investing in GE, no one's gone to jail yet, than they have investing in, well, possibly not Valiant, but a few other similar companies that have got headlines for fraud. Rolls-Royce, British Aerospace, Baidu. There are lots of companies that we would suggest are the nicest way is to say disingenuous with their accounts. Misleading tends to be a technical term or a legal term, so we try and avoid that. We tend to use misguiding, but you get the point. So today, I want to have a look at creative accounting, then go on to auditors. Are they the shareholder's friend or foe? Revenue recognition. Really approve of the change in standards. Can't believe the regulators left so many loopholes that the creative accountant can walk through and still have a lot of fun. Leasing. Again, a look to be a very sensible standard. Come on guys, it's time you brought that leverage on board. And we've already seen people abusing it, changing the rules so that they can change their disclosure. Then we go on to equity compensation, which I think is the most misunderstood accounting issue at the world at the moment, and allows people to scam off enormous amounts of money perfectly legitimately and to hide that. I mean, forget the morality of buybacks and all that other stuff. If they just got the accounting for it right in the first place, it would change people's behavior. ESG. Now, what a laugh that is. There are lots and lots of good reasons to promote ESG, and I am totally behind all of them. However, what we've seen is the rise of box ticking and the ability, for example, just to give you one quick example, ETFs that promote this stuff and talk about how they want to promote good environmental, social, and governance standards. Well, they rate whether you are a pig farmer with exactly the same level as to whether you have AGMs or not. Now, to me, that doesn't make any sense, and we continue to maintain that But Vanguard, the methods that Vanguard, BlackRock, and people like that who run ESG funds, ETFs, are essentially committing fraud on their investors, because box ticking like that does no one any good at all. A few requests for regulators. I think there are some regulators around here. I would love to see them read just a couple of those comments. And then finally, we talk about short reports. Short selling is, in my mind, if you're happy for people to buy and go long, you shouldn't have any problem with people selling and going short. It's exactly the same thing, just the opposite way. There are some cool lingo like short and distort, which allows people to complain. But there are some fairly simple things that lawyers and accountants can do, and if you're not being a dodgy company management sponsor, they are easy to refute, because short sellers and the like have far less information than you do. If, obviously, you are being a dodgy so-and-so, well, tough, and they don't have much sympathy. Creative accounting. When we sort of think about this, it's spawned effectively by what we see as growth decay. In other words, you were a highly rated stock, you have massive amounts of share compensation that rely on you meeting certain targets. Growth starts to slow, so either you can give up your opportunity to become immensely rich, or you can start fiddling the assumptions and juicing the goods. Alternatively, you are a value company, the business model is finally deteriorating, think Thomas Cook, but think Thomas Cook 2 years ago, and consequently you start juicing everything, fiddling your working capital, capitalizing expenses you shouldn't be, in the hope that you can turn the business around. Unfortunately, on our basis, what tends to happen is that if somebody's using one creative accounting method, yeah, there's a good chance they can turn it around. By the time they're using 15, they're really cleaning out the bottom of the barrel, and the company almost inevitably goes bust. Which is why we split all of our tests and all of our concepts into this GAP, which is governance. Do you have an overbearing boss? Will people do what they say? Yes, that's really helpful. Think Enron, think Nissan, Carlos Ghosn, GE, Jack Welch. Then how do you do it? Well, you play around with the various accounting assumptions, and all of which are obviously not perfectly reasonable and conservative assumptions used by a pragmatic management that are totally disclaimable. The problem is they're usually absolute rubbish, and when you compare it to some of their peers, they look even more stupid, but people don't, so they get away with it. And then finally, performance. As we say, talk about growth decay. 3 good examples there: Baidu, BMW, Tesla. Why do we think Tesla's juicing the numbers? Because guess what? Forget what they're actually doing to juice the numbers, but when you think about it, it has an enormous valuation. Its whole business model relies on raising capital at extremely high multiples. If it can't do that, and it shrinks down the sort of multiples of VW, or God forbid Ford or GM or someone like that, the whole story is over, and everybody's equity compensation goes to zero. So we talk about governance risk, accounting risk, and peer performance risk, and that's how we measure and test things. But there is a myth that it's all those crooked people in Asia, and in particular China, who are the dodgy so-and-sos misleading poor innocent Americans. The reality is the Americans led the way and still lead the way. And the way that we think about it is that in Asia you tend to get fake it to make it and straight theft, but we'll ignore the straight theft for the moment. But somebody says my business is really big, but the economy and time allows them to grow into that, and they bizarrely become less creative as time goes on. And actually, government-owned institutions in China, we feel, have fairly straight accounting practices for 2 reasons. One, there is no incentive for management really to juice the numbers. If they want to juice the numbers, they just set up a private enterprise on the side that never gets included in the accounts and get rich that way. So they don't have to worry about a listed company. Whereas in America, you've got a lot of people who've been employed. They're only really allowed to work typically for one company, and they can make transgenerational wealth by juicing the system and using equity compensation. Well, it's not a surprise that they are the people who try and juice the share price. It also happens to Europe and Japan, but America, as we say, stands out. Old classics, what do people do? They bring profits forward. This is an extract from Rolls-Royce's accounts last year, and they push costs back and they inflate asset valuations. old, tried and tested techniques. The question is, unless you know what the rest of the industry is doing, compare it to the rest of the industry and have a think and read the dirty details, you can skip over it quite quickly. The problem is, everybody will always turn around and say, oh, well, it was auditor approved. And we're like, okay, but what actually did the auditor approve? And auditors, in our view, get quite a bad rap because there is this anomaly where auditors, as we all know, are voted for at the AGM and their fees get approved at the AGM. And you think, why on earth does anyone do that? Well, because in the old days when shareholders actually had a proper voice, it mattered what the shareholders say. The reality is auditors work for government, sorry, not the government, the management, almost the same. And in our view, auditors actually have two jobs. One, to stop the staff nicking money. And they're usually pretty good at that. And the other job is to ensure management gets paid as much as possible. And that is by approving the accounts and juicing the numbers in the way that management wants them juiced. And again, we think auditors are pretty good at that. So consequently, we actually think auditors do a pretty good role. It's just not the role that most people think they're doing. We have some requests to the regulators. First of all, why aren't auditors approved by the board and paid for by the board? Then at least to be honest who they're working for. Directors should actually become responsible for the accounts. We had an interesting situation here, a company I was quite heavily involved in writing about, a company called Noble Group, and they turned around and said, oh, well, you're complaining about this rather dodgy valuation of some assets that are theoretical assets. Well, the auditors approved it, and then about 50 pages on in the accounts, the auditor turned around and said, oh, this is a very difficult asset to value, so we relied on management, neatly providing a circularity that meant that no one's actually gone to, I don't think they've even really gone to court, never mind gone to jail. And we see that quite a lot. So please, regulators, can we do something about that? And I also think that auditors should actually be forced to present the accounts, not management, at the AGM, because that would enable people to ask proper questions. Now, auditing costs, this is one of the strangest things that I've come across. I'm not bagging PwC because I could run this chart for any of the major accounting firms. But you can see there, and I realise it's tiny type, but what we've got is North America at the back, China, then Europe, Asia, and Japan. Now, auditing fees are a laugh in Japan. It's no surprise that we have the problems that we do. But, even in America, there is a huge spread of fees. And I wonder, you look at this and think, well, everything else, there is a sort of, not so much a going rate for the job, but you'd think there'd be some correlation between audit fees and companies. Well, let's have a look at the next slide. Apple, with revenue of $265 billion, and it pays $18 million to get audited. Now, I thought they'd got operations all over the world. I thought they were doing in lots of different businesses. And they have retail shops. So I realise they're good at computers, but presumably they've got to be pretty efficient to get away with 16. IBM or Microsoft, much lower revenue, similar-ish sort of numbers of staff, and their assets aren't that different too, pay much, much higher auditor fees. Either the auditors at some are incompetent or the systems are bad, but as an outsider, I really struggle to understand how it's possible that Apple can be seriously audited for $16 million. By the way, they have a private hedge fund that's huge, and if you speak to most private hedge funds that get audited, their audit fees alone would cost for a fair amount of that $16 million. Then we come down to some interesting numbers, and I realise these companies aren't in exactly the same business, but you get a sense. Now, GE, I don't know whether the auditors are in bed with senior management, but it is quite clear that despite some pretty dubious accounting, and we've all come across, they are getting rich off that fat, juicy belly that is GE. When you compare it to these other guys, you're thinking, what is occurring? And so for us, we look at some of this stuff, and we're always interested in auditing fees, both at the extremely, what you might describe, rich end, like GE, and the extremely poor end, like Apple, because our understanding of auditing is that someone's supposed to go along and check the accounts, and presumably that actually takes a certain amount of time, and as most accountants bill by the hour, we're sitting there going, so they don't spend any time on Apple's accounts, or they spend or they live with EGE. I'm not quite sure. Anyway, revenue recognition really stood out with a company called Bombardier in Canada, one of our most hated companies in terms of creative accounting. They have used pretty much every trick in the book, but it's not possibly surprising given that their board of directors actually lives overseas and the only person that lives in Canada is the MD and the family who've been doing nefarious deeds for quite a long time. But they, when the revenue recognition came along, they turned around and said, oh, whoops, we pre-booked $500 million of profits. I thought, okay, well, maybe it's some sort of difficult lease accounting or contingent liability. No, what they were doing was they would sell somebody what's called a train set for all of us over 12. It's a bit like the old train set, but it's when you go along to somewhere like Frankfurt and say we will put in a whole set of locomotions and carriages and stuff like that. And what Bombardier were doing was they were saying, well, once we've agreed to sell one and they've got an option on the next one, we'll book all the revenue and the profit on the option on the next one, even though we haven't actually delivered the first one. I don't even know how you got away with that under the old revenue recognition rules, but okay, at least it's come back this time. But of course, what it's done is it's enabled them, and management, when people are paid on profitability, is management got to book it once, and their equity compensation when it was booked first time, and now they get to book it all over again. So they get to be paid twice on exactly the same work and the same revenue. And as far as we've seen, we have yet to see anybody's accounts where they went, oh, sorry, we paid all our managers before, so we're going to take it off their pay. Just, funnily enough, hasn't happened. We haven't seen it. And we do try and read the disclosure quite carefully. Yeah, an estimate still remains subjective. This is more blurb from Rolls-Royce, so I can say anything. And it's basically, we've stuck our finger in the air and we've pulled all the revenue and profits forward and we've left all the costs in the future because I'll have retired by then and my bonuses have already been paid. Leasing. The good news, we think this is a great improvement. We think it's still fairly poorly understood by investment research and what we call the sell side. It is remarkably well understood by CFOs and remarkably poorly understood by the buy side. People got into the great pleasures of using this wonderful measure, EV to EBITDA, and said that the enterprise value of a company was the market cap plus the net debt. What's net debt? Oh, well, it says cash, balance sheet. Management's told me this is what net debt is. Okay, great. Well, I'll use that figure. Neglecting to note the leasing, reverse repoing, which completely manipulated the cash and debt figure. The good news, however, is bringing leases on board has heightened awareness. There are an awful lot of leases that are contingent. In other words, I lease a shop, and I think this was something that very much came out of Asia, but has definitely gone elsewhere in the world. And instead of renting it, I leased it, and I was paying $100 in rent, and I now pay $100 in lease, and then I do really well. Shop goes well, and the landlord, because in Hong Kong they're not known for being less than completely avaricious, said it's not fair that a shop owner should actually make some profits. It's about time that landlord makes some profits because we need a new helicopter this year. And they then turned around and said, so I tell you what, the deal we'll cut with you is that you have a fixed lease of, say, $90, and we will take 10% of your turnover once it gets over today's rate. Great, so you've now split it into fixed and contingent. And that steady state, and under old disclosure, that was quite reasonable, and people would just say, my estimate for the next few years is this, which included both fixed and contingent. What we've seen this year is everybody's come along and said, oh God, we've got to put this on our balance sheet, and I know, the contingent bit, I don't know. And I won't know till the end of the year. So A, it's an under 1 year part of the lease, so I don't have to disclose that. And B, it could be really bad. So even if I did have to disclose it, I'll make it, a pound, a dollar. Sorry, get my currencies right. Funnily enough, we're already starting to see people move away from fixed leases, boost the contingent bit, lower the fixed, and voila, your leasing, which was supposed to have come on balance sheet, starts to disappear again. And yeah, of course they're abiding by the book. We don't know. Our auditors signed off. It filled the formula, but it's somewhat disingenuous because you and I know that that landlord expects a certain amount of money, and they may have lowered the fixed bit, but they're expecting the contingent bit. This has got on to companies being intrigued. They will all tell you that there has been no change to the business model, no change to the cash flow, and anyone who's looked at the whole change of lease accounting, that's absolutely true. But it's remarkable how many IR presentations have talked about a lift in profits. Operating profits, Rolls-Royce operating profits up 30% this year. Oh, that's really, really good news. Revenue's up as well. Wow, margins must be improving. No, they just did the lease accounting that they said they should do, and actually their profit margins have fallen. We've also seen people come along and say, oh, you know, we signed that deal. Oh, very difficult. It's quite a lot of money. But I know. Why don't we completely revalue it, write down retained earnings? Oh, that might hit management compensation. No, it's a one-off, so we don't need to do that. Thank goodness for that. And so we maintain how well we get paid. We've just screwed the investors. And guess what? Profit's going to rise next year because we've just taken a massive write-off of the book last year. Perfect. Everyone's happy apart from the investor. So the future, as I say, we expect contracts to continue to be rewritten. Leasing as a liability will probably fall, not rise. The other great thing is, and I don't know how much of you guys have been promoting this, the use of leasing and purchase optionality structures, where you come along and you say, I will sell you something and you'll grant me the option to buy it back and I'll grant you the option to buy it. So I don't really own it anymore. I don't really have the liability because it's kind of an option, and if we do a sort of tweaky bit, then we can discount it, we'll talk about volatility, and we'll basically say, well, it's no value whatsoever. Both of us in the full knowledge of the fact that we're expected to make money out of it. The other area that has remained untouched, and hello the regulators if you're out there, is leaseors. Why? Because everyone's like, oh, because the assets come on balance sheet and you lend them out and all the rest of it. Yes, but there's huge amounts of room for dodgy accounting in leaseors. And in our experience, we've yet to see a business, excluding financial institutions, and by the way, GE is not a financial institution. You can lose money like one, but that's not quite the same as being one. You know, car companies, or as soon as people start leasing, you know their business is going to hell. Why? Because why would you offer free financing to somebody if you could sell stuff at full price? You wouldn't. As we discussed it, the last refuge of the commercially damned, and the reason why we don't like leasing is because, in terms of leaseors, and from an accounting perspective, is because people stuff the revenue, as in interest income effectively, in the top line, and they stuff the cost of that revenue in finance costs, and the depreciation of that revenue, which is effectively a cost of goods sold when you think about it, down in EBITDA, and we all know that, hey, it's not about net income, it's about EBITDA, and that, as long as that goes up, it's representing cash costs, only to the naive. But consequently, when people come along and say, oh, I value Ford on an EV to EBITDA basis, you know, they're just deluding themselves. But guess what? It's really good for management, and it's even better for management when they're paid on some level of adjusted, cost-free EBITDA profit number. So, regulators, please, can we have a look at leaseors at some stage? Equity compensation. I agree with the concept. I think it's a good idea. However, I would love to see a degree of reality. If you look into the accounting for equity compensation, there are some just fundamental flaws. First of all, we allocate the cost of equity compensation over the grant period. Well, that's not how the employees see it. The employees see it, it's part of my pay this year. And yes, I've got to hang around, but I'm expecting to get some more next year, and some more the year afterwards. You know, you don't come along and say, well, I'm going to cost allocate your salary over the whole time of you working at the company. So, and guess what? By allocating it over time, it becomes ever more misleading. Because let's say you are a company whose share price has gone up, the value to you of that equity compensation in the second year, let's be really generous and assume that it's not options and it's just stock, and it was issued to you at the market price in the year one, well, The cost to the company in year 2 is not the price they issued to you at, it's the price they issued to you at, plus the opportunity cost of not issuing it that year. But funnily enough, that never gets put in there. And when you start mapping that out with share options, it just gets worse and worse and worse. And then, of course, there is the secondary benefit where management says, oh, well, when we issue stock, it's a non-cash cost. When we buy it back, it's a cost of finance. And that is a cash cost, but that goes down way down there in cost of capital. Now, when I did my accounting, there was this thing called the matching principle, where you came along and said you have a cost and you have a revenue and you tried to put the two together.